What if I told you that Japan, a country with just 2% of the world's population, could single-handedly crash your stock portfolio and trigger the next global recession? Most people don't spend much time thinking about Japan's economy. It's on the other side of the world, rarely making headlines like the US or China. But here's the shocking reality. Japan just released economic data that has sent shockwaves through global markets, and the implications are far worse than what happened in Greece. Japan's government bonds are collapsing. Their 30-year bond yields just hit 3%, while 40-year bonds reached an all-time high of 3.6%. For a country that's survived on near-zero interest rates for decades, this is catastrophic. Bond auctions are failing as investors refuse to buy Japanese debt without massive premiums. The Bank of Japan, which has been artificially propping up the bond market by buying half of all government bonds, is finally backing away. But why should you care about Japanese bonds when you're probably focused on your own financial future? Because Japan isn't just another country. It's one of the biggest creditors on earth, holding over $1 trillion in US government debt. For 3 decades, Japan has been the engine powering the world's riskiest financial bets through something called the yen carry trade. Here's how this financial cheat code worked. Investors borrowed money in Japanese yen at ultra-low interest rates, converted it to dollars or euros, then invested in higher-yielding assets worldwide. The difference between Japan's near-zero borrowing costs and higher returns elsewhere became free profit. At its peak, Bloomberg estimated carry trades involving the yen reached hundreds of billions of dollars globally. This system worked perfectly until it didn't. In 2024, we witnessed the first major unwinding when the Bank of Japan raised rates for the first time in decades. The yen spiked over 10% in just weeks, causing Japanese markets to crash, US stocks to sell off, and Bitcoin to plummet. JP Morgan warned this unwinding was only halfway complete. Now in 2025, that prediction is proving accurate. The demographic crisis behind Japan's problems makes this situation unprecedented. Japan is the oldest country in the world with 30% of its population over 65. Its birth rate has been below replacement for decades, and by 2050, Japan is expected to lose 20 million people. That's equivalent to everyone in Florida disappearing. This aging crisis creates a vicious cycle. Fewer workers means less tax revenue and slower growth. More retirees means higher government spending on healthcare and pensions. The only way to keep this system running is through massive borrowing, which is why Japan now has the highest debt-to-GDP ratio in the developed world at over 260%. For years, this worked because Japan could borrow at virtually zero interest rates. But now, as the Bank of Japan steps back and market forces take over, investors are demanding real returns to hold Japanese debt. The government faces an impossible choice: raise interest rates to attract bond buyers but risk bankrupting the government, or keep rates low but watch the yen collapse and import costs skyrocket. Here's where it gets really interesting for your investments. As this crisis unfolds, we're seeing capital flee traditional safe havens. Companies like Metaplanet, a Japanese firm holding thousands of Bitcoin, have seen their stock price explode as investors treat it as a hedge against Japan's bond market collapse. This isn't just about one company, it represents a broader shift toward assets that exist outside the traditional financial system. The global implications are staggering. If Japan starts selling its $1 trillion in US Treasury holdings, American borrowing costs could spike. Interest rates in the US might rise not because of inflation, but because one of our biggest lenders just walked away. Even Japan's finance minister recently suggested their US Treasury holdings could be used as leverage in trade negotiations. This crisis exposes the fundamental problem with our debt-based global financial system. When interest rates must stay near zero to prevent government bankruptcy, but staying at zero destroys currency values and creates inflation, there's no good option left. As financial analyst Lynn Alden puts it, when global debt is this high and demographics this broken, there's really only one way out: currency devaluation and the gradual realization that nothing stops this strain. This is why Bitcoin quietly reached new all-time highs while most people weren't paying attention. The world is slowly waking up to what Bitcoin advocates have argued since the beginning. This debt-based system might not be sustainable long-term. Bitcoin offers something traditional assets can't. It's finite, decentralized, and immune to bond auction failures or yield curve manipulation. Japan's crisis isn't happening in isolation. The US faces similar demographic challenges and mounting debt burdens. The difference is timing. Japan is simply further along the curve, giving us a preview of what's coming globally. The investment implications are profound. While I maintain a diversified portfolio, including stocks for long-term stability, I've been dollar cost averaging into Bitcoin precisely because this story makes fundamental sense. We're witnessing the slow-motion unwinding of the post-war financial order, and Japan is just the first domino to fall. This isn't financial advice, but rather a wake-up call about the unprecedented economic forces reshaping our world. The era of easy money is ending, and Japan's crisis is the canary in the coal mine for what's coming next. If you found this eye-opening, don't stop here. Dive into our explosive investigation of America's missing gold, the biggest cover-up in history. In that video, we expose Fort Knox's untold secrets, uncover how opaque audits have left trillions unaccounted for, and reveal why this cover-up could upend your financial future. Click the link on screen or in the description now to uncover the hidden truth and supercharge your money mastery.